Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewers. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of April 6, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at an option strategy this week called a Calander Spread. Now, a Calander Spread is something that Viper indulged in recently with a few earnings trade, notably the Dollar Tree. And so we'll take a look at a little bit on how he views the Calander Spread. We're also going to talk a little bit about what is a Calander Spread. And then I think we'll try to take a look at a couple of possible upcoming earnings trades and the difference between the Calander Spread in those and maybe a more traditional play that I'm more accustomed to, which would be the short strangle. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagig.com/sprocket888, as well as /ViperXL007, where both of us post our equity trades, the good, the bad, and the ugly. Also, this is available in an audio-only format, so wherever you get your podcasts, look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's episode. Viper, the Calander Spread. This is notably a trade that I admittedly have really never put on. I suppose once upon a time when I was learning different strategies and different things, I probably tried one. However, I don't really recall it. So I can't say that I've ever really done much of it, but in concept, I will give a slight introduction on what the Calander Spread actually is. And then maybe you can talk us through a little bit about what you did with the Calander Spread and why you did it. So a Calander Spread is basically trading options of the same strike at two different expirations. And it doesn't really dictate whether or not you have to take a bullish position or a bearish position. The point is you take the same strike and you place opposite trades on them. So on one, you might sell expiration in the current month, and you might buy an expiration next month or 2 months out. And you do this at the same strike. And so one option will expire sooner than the other. The other piece of the Calander Spread is you will typically sell one and buy the other. So you might want to sell the short expiring option and buy the longer dated one. You might also flip it around, and it really kind of depends on what type of view that you want to express in the particular underlying that you're trading in. It can be a profitable strategy. People do it. But like I said, I don't know much about it, not from experience at least. I only know conceptually what it is. But Viper, I think that I would say you probably have placed more of these than myself. So talk me through a little bit about your exposure to the Calander Spread.
Yeah. So how did this come about? So in the ever-present search for, what do we want to call it? Determinism, statistic probability. I always keep my eye open for different strategies that people are using, having success with, and specifically that have a very specific set of rule set, if you will. So this particular strategy came about because YouTube was doing what it does, and it was feeding me videos, and the video itself was 1,000% clickbait. I mean, it was, the title was, "This trading strategy turned $1,000 into $1 million in a year," or something like that. I was like, okay, right. So
it worked.
Right.
Clickbait works.
It does. I clicked. I mean, and I don't know. It's weird. I don't know why. I don't normally click those because it's just egregious. But also, usually if I click them, it's like, give me 10 seconds to catch my attention. And if it is this, hyped up steroids, neon, everything in your face, I'm out. But in this particular case, this guy, like, the video did not match the thumbnail and the clickbait at all. And then so I just listened for a little bit. And so he starts going into this equation, this math formula that he derived to call out earnings plays on options. And so again, that ticked an interest of like, hey, yeah, earnings options, like I'm interested. Obviously, it's a big part of Sprocket's strategy there to play earnings. And then he starts going into his equation, which we're not going to get super detailed into. There's just a couple points I'll call out in a little bit. But he explained it, and he explained it in great detail, great technical mathematical detail. And he called out the Calander Spread, and that is the vehicle that this strategy uses. And then what was most interesting to me was because obviously, I mean, you can sneeze and find a YouTube video of like, this strategy works. And I mean, I've certainly come up with strategies, and in our Discord, I've been like, this strategy works. And then next week, it sucks. So the thing behind that, and the quick learning lesson behind that, is not just back testing, not just forward testing, but alternative market testing. And so what the heck does that mean? And the nugget of this video for you to go research on your own is Monte Carlo simulations. We've kind of mentioned them a couple times before, but very interesting stuff to look into. Basically, Monte Carlo simulations are you take this huge span of time and then you simulate entirely different markets, thousands, hundreds of thousands of times. And you can run a strategy through that. So he did a Monte Carlo simulation on this thing, presented all the data, all the findings. And he even claimed at one point, he was like, yeah, I mean, it doesn't really doesn't realistically turn $1,000 into $1 million unless you blah, blah, blah. But, nonetheless, that was the statistical stuff that, it checked that box. So I was like, I'm interested. And it's a script, it's a formula. And so I was like, it's in the description, anybody can take it and use it. So, that was kind of how I came to it was the mathematical formula, the back testing, the Monte Carlo simulations, the profitability of the strategy. And then the vehicle, this Calander Spread, I had never heard it before. And I believe I asked in the Discord, in Blockhead Traders Discord, if anybody's used it. And I think you said something similar there. So here's what I love about it, regardless of the underlying mechanics, which we'll get into in a minute. But what I love about it is end-to-end, fully identified risk management or whatever you want to call it. So like you said, in this particular strategy, I am selling the short month and buying the long month, and I use a month between them, a month between the expirations, same exact strike. And it costs a debit up front, because how the pricing of the options work out. So it costs a debit up front, but that's it. Like, you're done. That's the risk is whatever that cost is. So if it's $50, it's $50, and there will never be any more amount owed or anything like that. And then there's also a maximum profit known right up front. So that can immediately factor into my calculation on risk to reward and all that stuff. So that's essentially how it came to be, was how I found it that way.
All right. And you deployed this strategy in recent earnings, right? I think it was Dollar Tree.
I did. So Dollar Tree hit the screener. So I made a screener because, again, this script was available from this guy. He made a Python form that basically popped up a text box, and you put in a ticker, and then it gave you a thumbs up or thumbs down and it judges it on 3 different criteria. In the age of generative AI coding, I took the script and I said, I want something a little more functional for this. So I made a whole screener where you can click a button and it says, here's today's earnings. And then it runs each ticker through the thing, gives you a thumbs up, thumbs down, and then gives you a ranking of each of the 3 metrics. So yes, Dollar Tree spiked on that screener. Average volume was good. The implied volatility to realized volatility or realistic, I forget what it is, RV, that ratio passed the test, and the slope of the term slope, but the volatility curve passed that test. So Dollar Tree spiked on it. And I guess this is where I'll talk a little bit about how I use the calendar spread specifically for earnings and see if it resonates at all, or if you have a different view of how you would potentially use a calendar spread. But because this data that I am calculating, the average volume isn't super important. It's kind of important, but I mean, that's just for liquidity. So some arbitrary threshold, I think 1.5 million is what I look for. The IV-RV ratio is essentially the same kind of implied volatility screening that you do in your strategy. In this particular case, the IV to RV ratio is so the mathematical formula that he's using is apparently something called the Yang-Zhang volatility estimator, which is supposedly a much more accurate measure of volatility because it actually calculates and accounts for after-hour gaps and intraday volatility. So that's my volatility measurement. And long story short is want elevated volatility, same reasons that you do in your strategies. And then it calculates the term structure slope, which is essentially looking for something called backwardation, which is where there's actually an arbitrage opportunity in the premium between these 2 expirations. Essentially, the short month is not being it's being overpriced in comparison to the long month. And so ultimately, at the end of the day, that's what my usage of the calendar spread is, trying to capture that backwardation, that improper pricing of the front month and the back month. Therefore, I sell the front month and I buy the back month because I'm essentially trying to capture the arbitrage of that price correcting itself. So Dollar Tree spiked up and met all those criteria. And I bought it. I bought the calendar spread, I think either I think it was like 2 days before earnings. And I hear that it also spiked up on your radar.
Yeah, so a couple things before we jump into that. Backwardation, super interesting that is what you're measuring. When you entered the expirations for your Dollar Tree, what were your expirations of the short and the long month?
So my expirations were about a month apart. And in this particular case, earnings were on the 26th. I believe I bought this thing on the 24th, and my short month expiration was the 28th. So it was just 2 days after 2 days after earnings. And then the long month was April 25th. So just a little less than a month, I guess.
Okay. So that actually that's actually very interesting because what you're proposing or what you did actually, I think, would make a lot of sense. So backwardation is interesting concept that we talked about, oh man, forever ago when we were kind of figuring out when to take out insurance policies. I don't know if you remember those episodes, Viper. But what backwardation basically means is the volatility on the short end is higher than the volatility on the long end, which is basically backwards from where it should be. And so if you watch like the VIX, a common measurement is the 1 month VIX volatility over the 3 month VIX. And if that anytime you cross over one, basically get higher than one, you're in backwardation, which means that there's more volatility on the front end of the market than the back end of the market. And that usually means we are in for a really rough ride on the near term. And when you're selling premium, that makes a lot of sense to want to sell that short term one, which has that elevated volatility relative to the long option. And so the way you set up your earnings trade is almost, honestly, it's what I can see working, but it's not actually what I was thinking of when I give the demo a little bit later. What you're basically doing is kind of using that elevated volatility to buy your lottery card, if you would, on that longer dated option. So it's almost like you're shooting for that directional play on that longer dated option, looking more for the price movement after that volatility contraction, and you're hoping to build volatility potentially after you get the initial contraction.
Yeah. So my understanding and how I'm conducting my trades for the initial data collection period is exactly what you said, trying to capture that elevated volatility on the front month, while at the same time not losing a whole ton of value on the long month on the back end. However, that does lend itself to needing a semi-stable price. And so that is certainly something that's come up in my experience so far, which is feels like a little bit of a juxtaposition that this script also calculates an expected move, and it's similar to how your brokerage screeners will calculate the expected move. It's using the options pricing to calculate what the market is expecting the move to be, and so it's this almost catch-22 of like the better opportunity has a high expected move, and so. But I also need price to be somewhat stable per whatever strike I use. And so I've definitely been finding that as part of the, I guess struggle initially, but also needing to see this play out over more trades is the expected move, but does it do the move and then come back and then I can close it out? That sort of thing is part of the data collection process and journaling. But that is essentially what I'm trying to capture is the front month is elevated. I want to capture preservation on the back month on the long contract because I'm eventually going to sell that back. But in the ideal world, the collapse, the crush of volatility on the front month allows me to have captured that contract. It crushes, becomes virtually worthless. Price is similar, and then it's just bonus. Like I get my money back, I get my debit back just from the crush on the short month, but then I get icing on the cake by being able to sell back that long month, in theory anyway.
Yeah, Viper, let's take a look here at an earnings trade that will be coming up next month, or this month, I should say, in Royal Caribbean, ticker RCL. And what I want to do is I want to pull up the option chain of RCL, and I want to take a look at two different ways to kind of play this from earnings. And I'll give you the way that I think I have seen most people play calendar earnings, and that is you want to basically kind of play the calendar earnings such that you get rid of the play before the earnings announcement. And so what you would do is you would be selling the front month of the option, whatever you choose, something before earnings. And then you would want to buy the longer dated option, something that expires after earnings. But what you're going to want to do is close out the trade before the earnings announcement actually comes out. Is how I've read and seen this. And what that they're looking to do there is you're looking to take that buildup of earnings of your long option. As earnings get closer and closer, that option should be building and building premium. And then when it arrives there, that's when you want to sell it before that volatility pops out of it. And then you're going to offset the cost of that by selling something that expires before earnings And the idea is all that premium and volatility will decay away prior to earnings, and you'll keep all of that premium, and that helps offset the increased cost of that longer dated option. So the thesis here is the price is not going to move very much, is what you don't want. You don't want large price movements prior to earnings. And so what I've done here is I've pulled up Royal Caribbean. They have earnings on April 24th. And so if I look at the option chain, you don't have a ton of difference here, but what I'm doing is I'm saying, hey, let's go look at the week of earnings expiration, which is 51.78 implied volatility versus the week before 51.12. So, okay, we're going to basically be buying and selling at the same volatility level. And that is a good thing, I think, because what we're anticipating is this April 25th is going to expand in volatility as earnings approach. And yes, your short one will also expand, but it's going to expire before earnings. So it's not going to expand as much because it's going to be done before the earnings even come out. So the volatility is getting priced in from the earnings uncertainty. Now, you could go further out into anything else out there because everything from the earnings date, anything that's past the earnings date and expiration is going to have more and more volatility expansion. And so I'm just going to pick the 25th because that is the closest thing to the comparison trade of a short strangle. So what I would do is I would sell an April 17th put, let's say, and I would buy an April 25th put at the same strike for that calendar spread. Now, currently, this is trading at about $212. And so what I believe you will want to do is actually trade close to the money when you do the calendar spread, because your theory is it's not going to move much from where it is today. So if we do this at that 200 strike, I'll put both of these on and we'll flip to the strangle in a minute. But if I look at this P&L chart, what you see here is your blue is going to be the profit at expiration. Now one will expire before the others, but you can see, you can make up to about $200 in premium here for this. Now you're going to pay a debit, and so you're going to pay about $195 in premium for this. But that is all the money that you would be out, is that $195. So it's kind of like a coin flip, at least when it comes to risk and reward here. But the key part, and this is why I think calendar spreads are kind of interesting, is they take no buying power. So you can put this trade on and it's going to cost you $195, nothing more, nothing less. There's no buying power expansion. There's no nothing. You get a little bit of increased probability because you're kind of selling premium, which could be overstated. And you know that volatility will build into earnings. And so that's where I see the benefit of this, is the amount of buying power needed to put this trade on. Now let's flip a little bit and take a look at what I would typically put on for this particular earnings. So what I would do is I would look at the option chain, and I would go to the week of earnings, which is April 25th, and I would probably put on about an 18 or 20 delta strangle. So here that's going to be a 185 or 190 strike on the put side, and on the call side, that delta is going to be around probably a 230 or 235. So if I go ahead and I put those strikes on and sell them, here is what my P&L chart looks like. Okay. So it's much, 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 much wider of profit. Okay. So you can see this is going out, I will make profit between 240 and 185. And I'm going to bring in $460. But the problem with this trade is it's going to consume $3,200 in buying power. So that's an enormous amount of money to make this trade. And you do have a much wider area of success, but you have a much, much larger need to have that, $3,200 in buying power. Yes, you collect more money, about double the premium that you can collect if you win. But at what cost? So Viper, I am not really an expert on calendar spreads. It's just not my style. But I do believe, based on this, P&L chart of looking here, if you do keep it within a particular range, you have a pretty decent risk to reward ratio. And I would imagine that if you could tweak some of the characteristics or understanding, like we always talk about on here, to know the mechanics of the underlying, you probably could push a little bit better, than what I think this is showing is like a 60% chance of probability of profit, somewhere around there, maybe 55, 60. You might be able to squeeze it up higher, depending on volatility conditions of the difference between the short and the long option, to maybe in the 65% probability of profit range. But how does this strike you?
It's real interesting because I feel like it speaks to kind of what you mentioned there a little bit, which is essentially the idea that everything has a cost. So in your particular approach, there's the buying power cost, but what does that cost get you? Well, it gets you this much wider window of potential success. Um, and on the calendar spread side, it's a more narrow window. But like you said, it's very approachable. And and I do think it's very important. Like, I mean, you can do a calendar spread on anything, anywhere, anytime. And if you just, like any mechanic we talk about, if you just walk into it, you're probably going to lose a bunch of money, like, because then you're just gambling. Just go to the casino. And so it's about whatever the mechanic is. It's about finding that probabilistic edge to give you the advantage to catch that window. So just to visualize this real quick, I just wanted to jump over to a chart here for another calendar spread that I put on, and that was our good old friend GameStop. So I had actually it was around this price. It wasn't day of, but it was a day or two before, but around $25. I entered a calendar spread. And what this ends up looking like is kind of like one of your Flappy Bird charts, basically. And so what I needed was for the price to normalize back around $25, and the earnings blew up, and this thing just shot up. The blue lines are where, if I had ridden this out to expiration, where the supposed break even points were. I haven't figured that out yet, as far as like in Robinhood, why it calls that break even. But nonetheless, on this initial move here that went way up to $30, that was a significant move for a calendar spread. So of the debit that I initially bought this thing at, it was down almost all of that. And this was early on. This was like the second or third calendar spread I ever took. And so expiration was 2 days later. So I ended up closing it out all the way up here. It was a loser. But we can see that, that whole thing came back. And if I had just waited one more day, this would have been perfect exit right there, because that is right there where that started. So, but that's just to visualize it, the visual of what you want to get out of the calendar spread. As I'm playing it, and as I think normally you would play it, I mean, in the scenario you played out as well, is that even Steven come back to this price point. So this was a learning moment. I just wanted to call it out, as far as, taking some losses, stumbling through. And as always, risk mitigation. I think I bought this. I think this was like a $60 debit, something like that. So it wasn't anything crazy for, having that skin in the game. But it was also important to call out of, it went against me. And then there was a moment of, I don't fully understand how this normally goes or what to do. So a little bit of a panic bailout, and then sure enough, price it's not guaranteed to come back down, but those strong volatility moves, normalization or mean reversion is something that I need to have a little more patience for. And I think in talking to you, Sprocket, this kind of came up of not in this strategy, but just when I've been buying options, that you kind of approach it as like that's your ticket price. That's so it kind of feels like that might have applied here a little bit as well. I don't know if you have that same thought to all these spreads in general of like this initial debit, that's your ticket price. Um, Maybe not ride it to expiration, but don't bail out early. Either it dies worthless or you take some profit on it. Do you think that still applies in this scenario?
Uh, Maybe a little bit. I struggle because I think if one of your goals is the volatility expansion on that long option, you do have a little bit of a ticking time bomb because your theta is decaying. So if you truly do stay in the middle, then that does kind of expire worthless. I mean, it does fit into the P&L. So I think it really depends on your goal of that long option. What I mean by that a little bit is one of the things that I think could work pretty well with a calendar is selling that option either the week of earnings or maybe just before earnings for the payment of the longer option, but make that longer option also your directional bias, right? So like let's say that you're super bearish on GameStop and you're like GameStop is going to tank on earnings, right? So you would get rid of your option, your short option, which you would sell in this case, to pay for that long option, which you bought after earnings. But rather than try to close it out because of volatility expansion, riding it through earnings and then hanging on to it for more the gamma exposure and the directional put side of it, that's where I would say hang on to the ticket. If it's more of, pricing that volatility expansion, you're going to be at a difficulty if that gets priced. It would be at a difficulty if that volatility completely doesn't build and the earnings event is gone. Um, I don't know.
Yeah,
I'm
no,
torn on that one.
yeah, that makes sense because I mean, in the case of buying options, I mean, it's obviously a completely different strategy, and it is 100% directional. you bought you bought the option for a particular move in a particular direction. So yeah, comparing it to like that's the cost of the ticket and what because the ticket can just keep going potentially in theory versus like you just said in this case and I did have this thought and I'm continuing to let it sit there that long option is your bailout, so to speak. I mean, the ideal play is that you get the volatility crushed and the front option loses all of its value, and then you can capture and close out by still getting the value out of the long option, which, like you just said, quickly becomes that ticking time bomb of theta decay. Because this is also if you do the trade, the spread where I'm doing it, which is 30 days out, I believe that's right there in that window where you try to get out of your premiums plays because of that theta decay.
So I think it really just depends on the mechanics and what your goal is, right? So like anything, understand the mechanics of how it is operating, and then leverage that and exploit that into your objective. So that brings us to the end of this week's episode where we touch on calendar spreads. We are by no means any sort of expert or have any sort of track record with calendar spreads to much more than a small handful of trades. But fundamentally, they are made up of the same building blocks of options that we frequently trade, or I definitely trade quite frequently, just in that particular package combination, not so much. And this is really where understanding those mechanics really come into play. I would say get into your brokerage, and every brokerage is going to have a P&L chart where you can mock up the trades that you want to take, and they will display that P&L That's what we pulled up here when we compared the calendar to the short strangle for a particular options trade or particular earning strategy. And I think just becoming familiar with that in your brokerage and trying out the different strategies to see when do they profit, when do they lose, how does that fit your thesis, how does that fit your risk tolerance. Like we said, one of the big benefits in my mind of the calendar spread is it is a known debit quantity for you. It does not expand. You will not be out any more money than what it costs you to buy that calendar spread. It does not take any buying power. It is great for small accounts. But with that comes a reduced probability of profit. Now, you can still get that in your favor or in your edge if you look for certain characteristics. And the short strangle 100% covers a much wider range of victory and profit potential, but it comes at a much larger cost in buying power. And I think that really just kind of speaks to that risk and reward phenomenon that happens in the market and everywhere. You know, the more risk that you're taking on, the higher the potential gain, and the less risk, the less potential gain. And finding that sweet spot around where you're comfortable with your risk tolerance and what fits your portfolio is really what it's all about. And, you know, Viper and I touch on all different types of vehicles, all different types of trading strategies, and it's not a one size fits all. You know, for smaller accounts, playing a short strangle is just not feasible on smaller accounts of less than, say, $5,000 to $10,000. You really have to be above that before playing a short strangle really becomes a thing that doesn't run the risk of really significantly denting your account. And that's where you have to look out at strategies like potentially the calendar, maybe the iron condor, maybe a call vertical or a put vertical, right? That's where you reduce the risk. Now, does it reduce the profit potential? Yes, but it fits the account, and managing risk is really where all traders differentiate. That's what differentiates traders. There's no, oh my gosh, he hits home runs all the time. The best traders, the greatest traders, are able to mitigate their risk and manage their risk appropriately. It's not that they pick a disproportionate number of winners to losers as somebody else. It's because they don't let their losers become things that will wipe them out. And they do that by risk management. So hopefully this has perked some curiosity for yourself to go do a little bit of Googling. You know, hop in the Discord, ask Viper and I some questions. Maybe this is something that you want to learn more about. Otherwise, good luck out there, have fun, and remember, think outside the block.